Affirm stock analysis is the topic of today's presentation. If you're somebody that's thinking about investing in AFRM stock or already invested in Affirm stock, then you want to watch this because we talk about some of the risks that may not be so obvious in a business model that's pretty slick on the tin. So Affirm takes advantage of people's desire for instant gratification. This is something caused by emotion overriding logic. Some say that it's increasing in society because of a reduction in attention span that largely comes from the instant feedback that you receive on social media. Another thing that we've observed in today's market is a lack of responsibility for bad financial decision making, where people write letters to the SEC asking for their money back when they invest in some crappy OTC stock or a meme stock. And we don't like business models that rely on people acting in a financially irresponsible manner. And the housing crisis is really a good example of what happens when you give people enough rope to hang themselves. So business models that we avoid would be anything involving unsecured loans, because these provide people with a less incentive to keep their loan current. So if you don't keep up on your rent, you get kicked out of your house. If you don't keep up on your car payment, you can't drive to work. But unsecured loans are different. Now, Lending Club, a company that we used before back in the day when they would let retail investors carry a portfolio of loans, and it was worth doing that just for how much you learned about, because you got to see people's reasons for, making a late payment or not being able to pay back their loan, or what they were using their loans for. And it was a really good look into the mind of the American consumer. We used it for 4 or 5 years, and it worked pretty well, but it taught us a lot about the amount of debt. So 40% of American households carry over $1 trillion of revolving debt. This is from Lending Club today. They paid an estimate $111 billion in fees and interest in 2021 alone. In 2022, the average credit card rate increased by over 400 bips. So that's from 16% to over, let's say roughly, to over 20%. And that will continue through this year. So they say, well, we exist to help Americans keep more of what they earn by providing access to more affordable credit. These people shouldn't be taking out credit, and many are living paycheck to paycheck. Now, there's the old saying that you sell to the rich, you live with the poor. You sell to the poor and you live with the rich. So there's certainly lots of money to be made in financing people for purchases. Here you can see Affirm's app. There you can pick a payment plan, and they offer these different options for people that at the point of checkout online, where 95% of their business comes from, you see that somebody could pay in 4 installments. That's always interest-free. So that's great. They offer these opportunities for people to pay without interest, and they don't have late fees. Now, when you look at what they say they do, they say the nature of credit cards makes it all too easy for consumers to fall or get left behind. So they flip the model on the head and they underwrite each transaction individually. And by never charging late fees, they don't profit when consumers fall behind. They say our success is fundamentally aligned with our consumers' success. Well, not really when you issue interest loans for over 30%, and you talk about wanting to get all your loans under a 36% cap. It's pretty easy to argue that anything in the 30% range is taking advantage of consumers. But anyways, their presentation deck is really a huge turnoff. It talks about how they're going to help everyone. That's usually a large red flag. And then they dive into more DEI rubbish than we've seen in other fintechs, which is a big red flag as well. Now, the question we'd have about Affirm's value proposition is how many people can really tell you what interest they're paying in their credit card debt and the corresponding terms, or even their auto loan. So are these customers using Affirm for the economic benefits, or because it's another method that they can use because their credit card's already maxed out? So when you look at the amount of revolving consumer credit right now, this is from Lending Club, it's at $1.2 trillion. You can see how it's at an all-time high there, and record high credit card interest rates are also peaked there, as you can see. This is not a good situation to be in when your goal is to extend more credit to people. So looking forward at today's stock market, bull or bear? Well, either this is a dead cat bounce or a recession that will finally recognize the impact of the coronavirus, or we're on the cusp of the greatest bull market ever because of AI. In either case, what you want to do is invest in a diversified basket of quality companies which account for both of those outcomes. Don't invest in a company where one of those potential outcomes will have dire effects. Now, when we look at how a firm makes money, this is an interesting breakdown of the various buckets, and we'll touch on each one, starting with merchant network revenue. This is rather innovative. So what they do is they tell merchants, listen, when somebody avails themselves of our payment method, we're going to pay you for the product, but we're going to pay you less. So you see this merchant discount rate. So they may pay them up to 8% less than the transaction that took place. So that's where they're scalping some money. That's where there's merchant network revenues come from. And this explains it. It says merchants pay us for incremental conversion, as most of these transactions would not have happened without Affirm. This is a good slide to look at. The column on the bottom there, or the row, shows the average amount of the purchase, and then you can see term lengths. Actually, those are rather confusing because their actual term lengths are quite low at an average, and then you can see there on interest-bearing 10% to 36%. So when we look at, they're loaning this money to customers, and when we look at where that goes after that loan happens, you can see that they carry some on balance sheet and some off balance sheet. And the off balance sheet there would be loans that they're packaging and selling to institutional investors. And then on balance sheet, those are loans that they have that are generating interest. That's where their largest revenue category comes from, interest income. And then when they sell loans, there's the gain on sales of loans, which accounts for 14% of their revenues. And you can see here, we've simply plotted across the top there the percentage of loans that sit on their balance sheet versus being sold to institutions. And you could probably argue this both ways, whether or not they want to keep those loans, generate the interest income, which is probably more than the upside they would get from selling those loans to institutions. But it's interesting to see they've hit an all-time high there of the percentage of overall loans that sit on their balance sheet. Now, the other thing they're getting into, these virtual card networks that they're building out. So over 80% of all retail spend occurs at physical retail, but that's less than 5% of a firm's volume for now. So they say the majority of consumer spend is denominated in small, sub-$25 transactions, and that frequency is the path to the top of the consumer wallet. So this is really just more unsecured credit being offered in the form of these credit cards they're sending out their customers. And then we just pulled this slide to show how there was a big conversation in their last letter that accompanied their earnings about their desire to get under the 36% APR cap and how much progress they were making towards that. These are very high interest rates. And if you're interested in helping consumers, and it's hard to see how you can say that and then also offer APRs this high. And of course, it's all about risk versus reward, and they probably have to do that to service some of the customers. By the way, they have their own proprietary method of determining somebody's credit, which is independent of traditional methods. And of course, they'll talk about their use of AI to improve upon that and whatnot. But when you look at their revenue and their operating expenses, it's very important to break this out, and they do this non-GAAP slide that explains things here. So when you remove depreciation and amortization, you remove stock-based compensation, and you remove this component called enterprise warrant and share base. We'll talk about that in a second. What you end up with here is a lot different outcome than, and on the left, so the left row that you see here, or say column that you see here, reflects what their actual numbers were. And on the right, you see where we've adjusted for the non-GAAP. And they're still not able to achieve a positive gross margin there. Let's say the gross margin is positive, so it's everything above that yellow highlight on the right there. Everything above that would work out to a 44% gross margin, but then you have the costs like general and administrative, sales and marketing, technology and data analytics, and then you still have an operating loss. But when you look at the movement of these items over time, you can see that they're working towards decreasing those. So presumably they can get towards profitability fairly soon. But one thing that we wanted to note here is the share-based payment expense category. Here you can see where Amazon has been exercising their warrants over time. That's part of the deal. You see that Amazon will do that with companies that they engage with, and Affirm had an exclusive arrangement with Amazon, which had expired, and it remains to be seen how that relationship goes moving forward. But the takeaways here: what's the likely outcome when you have record high consumer revolving debt and record high interest rates on said debt? So when people start to running into problems, who are they going to pay first? Firms that charge late fees or those that don't? And this increasing amount of loans that you see on their balance sheet, is that a result of less demand from loan purchasers, or is it their desire to increase interest income because there's more upside there than just selling loans? Now, Affirm is going to be constrained by their platform capacity, though duration is low. So here's what we mean by that. See how over time the average duration of their loans has been declining. So what for their total platform, it's around 12 months, 1 year. And for on-balance sheet, it's about 11 months. So they can cycle that, and that's a function of their funding capacity. You can see here last quarter, $11.4 billion. They had used up 71% of that. So is that external demand for securitized loans, is that drying up and constraining their capacity because their growth is really limited by that? So that's something to think about. Another thing to pay attention to here is the AI hype that's going around. So this article by the Motley Fool is certainly helping Upstart experience a strong growth in share price for no obvious reason. And the other firm they mentioned here is Lemonade. And we can tell what's being hyped out there based on people coming around asking us to cover different names. We've covered both. And I'll put a link to both of those pieces in the description of this video. But just to conclude, unsecured consumer debt isn't a niche we want exposure to. So Affirm might have the right idea at the wrong time. If we go further into a recession and consumers start feeling financial stress, then unsecured loans will be the first to suffer and will be impacted the most. And just how good are these proprietary credit rating algorithms, especially when they're being wielded by a firm that crams DEI down everyone's throat? So the way these algos work, they may produce some results that the DEI folks don't like, because that's the reality of the world. So we'd be very curious to know that those algos are allowed to operate as they should before the people start messing with them too much. Affirm doesn't help people as much as they claim to. That was a clear takeaway. They say one thing and they do another. It all comes down to this: the risk-reward ratio for Affirm stock isn't to our liking, and we'll be avoiding it going forward. So I've put up another video here for you to watch, but before you click that, please click the Nanalyze logo here on the right, subscribe to our channel. Thanks so much for taking the time to watch this today.